Good afternoon, everyone, and welcome. Okay, for just a moment, they are joining right now. Good afternoon, everyone. Welcome. My name is Daniela Crăciun, Secretary General of CEE Perspective. For those joining us for the first time, CEE Perspective is an independent association working to bring the priorities and experience of Central and Eastern Europe into European financial policy debates. And through our academy, we create direct conversations between policymakers, industry, market participants, and experts from the region, and of course, beyond. We try to ask the questions that can easily disappear when the European debate becomes too broad or too Brussels-centered. Today is a good example of why we do this. Today, the European Commission will publish its report on competitiveness of the EU banking sector. And it looks like we are faster than the Commission to discuss this topic. As many of you agree with me, the banking competitiveness may sound like a technical subject, but is the issue is much broader. Europe wants more investment, stronger companies, and greater economic resilience. Banks will be expected to finance a large part of that ambition. The question is whether Europe's current banking model allows them to do so effectively. Where does fragmentation still limit scale? Where has the framework become unnecessarily complex? How can cross-border banking work better? And how should banks, capital markets, and private capital complement one another? These questions are especially important for Central and Eastern Europe. Across much of the region, banks remain the main source of financing for households and businesses. Cross-border banking groups have played a major role in investment and economic convergence. Capital markets are developing, but they are still relatively shallow in many countries. The European debate must therefore reflect the realities of the whole Union, including economies where banks continue to carry more of the financing burden. Today, we will look at why banking competitiveness has moved so high up at the EU agenda, what may need to change in Europe's banking model, and what this agenda means for Central and Eastern Europe. I am very pleased to welcome Emilio Tornese, Head of Macrofinance and Macroprudential Policy Unit at the European Commission, Sebastian Stodulka, Head of EU Liaison Office at Erste Group Bank, Gonzalo Gassos, Senior Director of Prudential Policy and Supervision at the European Banking Federation, and Christoph Verbumen, Head of Regulatory Affairs at Invest Europe. The discussion will be moderated by Andrea Lungu, Lead Policy Expert at CEE Perspective. Please send us your questions throughout the session. We will bring as many as possible into the discussion. Thank you again for being with us. Andrea, over to you.
Thank you very much, Daniela, and thank you to Emiliano, Sebastian, Gonzalo, and Christoph for joining us today, particularly on the day of the much-anticipated Commission report on banking competitiveness. Daniela has already set out why this discussion matters. What I would add is that this forthcoming report marks an important shift in the European banking debate. Resilience and financial stability remain essential, but the discussion is increasingly focused on whether Europe's banking framework also allows banks to operate efficiently, to compete internationally, and to provide the financing the European economy needs. So the central question today is whether Europe has the right banking model for the next phase of its economic development, and whether the specific characteristics and financing needs of Central and Eastern Europe are fully reflected in that model. So we will therefore structure the discussion in three parts. So we will begin by looking at why banking competitiveness has become such a strategic EU issue. We will then turn to the policy questions, including market fragmentation, cross-border banking, regulatory complexity, and the relationship between banks and capital markets. And finally, we will focus specifically on what this agenda could mean for Central and Eastern Europe. So let's begin with the broader European picture. For much of the period following the global financial crisis, the EU banking debate focused primarily on resilience, supervision, and crisis prevention. Those objectives have not disappeared, but the debate is entering a new phase, one in which competitiveness, integration, and the capacity to finance growth are receiving much greater attention. So, Emiliano, I will start with you. So my question for you is, why has banking competitiveness moved so clearly up the EU policy agenda? And what is the underlying problem that the Commission is trying to solve? Emiliano, you have the floor.
So thank you very much, Daniela, Andrea. Daniela, you raise, and you, Andrea, as well, the very good questions. These are not easy questions. You raise also very good points in that respect. I would like to thank you for the invitation today, because today is a very important day for the Commission and for all of us. So the Commission is going to adopt and discuss and publish its report on competitiveness. And I will tell you a little bit what is the idea behind that. So the competitive banking sector is essential for a competitive European economy. So banking sector and the European economy go together. And as the EU seeks to finance growth, innovation, and its strategic priorities, banks need to be efficient, resilient, and able to operate across the single market. So why this is now a priority? In Europe, banks remain the main source of financing for household, businesses, and particularly SME. Beyond lending, they can also facilitate access to capital market and help channel savings into productive investment. That's why banking competitiveness is a key deliverable of EU initiatives like the Saving and Investment Union. So it's a key component of it. Let's not forget about it. The Competitiveness Compass, and as you mentioned, the recommendations of the Letta and Draghi report. So just think about the investment needs that the Draghi reports identify. An integrated single market in banking can play a key role in delivering these investments. So what is the Commission trying to solve? The main challenges are, of course, and you mentioned, fragmentation, a lack of scale. So although the EU has a single market, banks still face obstacles to operating across the borders. And this limits their ability to achieve scale, diversify risk, so very important also for financial stability, and offer a wider range of products and services, which is very good for our companies and our citizens. Let's remember that. So the objective is to enable banks to compete more effectively across Europe while remaining fully resilient. Moreover, as I said before, banking and capital markets must go hand in hand. So a more competitive banking sector and deeper capital markets will reinforce each other. An integrated single market in banking can help develop capital markets through investment and corporate finance services, while a more integrated capital market can create new opportunities and revenue streams for banks. Together, they strengthen the EU ability to finance its economy and reduce dependencies and reliance on non-EU financial institutions. Ultimately, competitiveness is about more than size. It also requires banks to be profitable, well-governed, and resilient. A stronger and more integrated banking sector is a key building block for Europe's long-term competitiveness, and let's remind, strategic autonomy. So I'll stop here for the first question.
Thank you very much, Emiliano. And that already points to the broader question about how the sector itself sees the challenge. So, Gonzalo, if I may now turn to you, from the perspective of the banking industry, how would you define the competitiveness problem? And is it mainly a question of profitability, regulatory burden, fragmentation, weak capital markets, or something more structural?
Well, thank you, Andrea. And I think, yes, very much in line with the first words by the Commission, Emiliano Tornese. I think the question of competitiveness is a very broad concept, and the ultimate goal is to increase the competitiveness of the European economy. That was very clearly stated in the Draghi report that estimated a gap in terms of innovation and competitiveness that was quantified a gap of yearly 800 billion investment that has only grown since then until the current figures estimated by the Commission of 1.2 trillion. So no matter what the figure is, the message is there is a lot of financing needs to be covered if we want to have a European competitive economy. And why banks are important? Unlike any other sector, the banking sector is a catalyzer of the European economy. And in that role, it is important to have a competitive, dynamic banking sector that is able to provide financing of all sorts to the European economy. And that is why this report of the Commission will put over the table the key issues that need to be discussed and reformed in some way to facilitate the role of banks in that direction. I always like to put a very clear example that we all lived, and to me is the proof of that key role. Let's come back 5 years ago to the pandemic. What happened there was that the whole supervisory community, policymaking, and banks wanted to have an incentive for banks to keep on lending to the economy. So even our supervisor said that by relieving 120 billion of capital, they would allow for 1.8 trillion of lending to flow towards the economy and avoid a credit shortage. So that is, to me, a very good example. The pandemic, it was an obvious, very visible threat in front of us. But the loss of competitiveness, as Draghi has alerted, is a very slow kind of soft deterioration of the European economy, and we shouldn't let time pass. So we need a quick reaction as soon as possible. And having said that, we have built a very safe banking system, what is good. We are in a very resilient position, but too much of a good thing can turn something into a problem. And that is the problem we have in front of us. Why is it a problem? Because the capacity of banks to finance the economy is constrained. It's constrained in two ways. In the overall volumes, because the requirements are excessive and are unpredictable, which means that banks need to also reserve some cushions because they don't have clarity as to what the capital requirements will be in the future. So we need to bring certainty. We need to calibrate the total capital requirements for the sector to find the right balance. And we also need to look in particular at the different portfolios. In the very safe banking system that we have built and with a very strict supervisor, the banks have been turning into plain vanilla business. That is investments in government bonds, in mortgages, of course, because that's very long-term. Also consumer short-term lending as well. But we would need more of long-term financing, low to medium and medium to high risk financing, leverage finance, why not? And this type of financing is not interesting in the current regulatory and supervisory framework. And we need to make it interesting for banks to step in that business. Otherwise, it will go elsewhere. In fact, we had a meeting last month with colleagues from Airbus, the leading aerospace company in Europe. This is public information. The financing of such a large company in a very competitive sector is relying on foreign banks, in particular Chinese or Japanese. And we need to look at that. Only 20% is European because there is no incentive. European banks are discouraged. We want to come back to finance the competitive part of the business, not only the plain vanilla governments and mortgage that the current regulatory framework lead us to. And I would stop there with some ideas because I know there are other speakers who will have very interesting things to say about this.
Thank you, Gonzalo. So that brings us quite naturally to the practical side of the question, because some of the constraints that we're discussing today are felt most clearly by banks operating across multiple European markets. So, Sebastian, let me bring you in here. ELSTE is a very useful lens for this discussion because it operates across a large part of Central and Eastern Europe. So looking at the issue from the perspective of a cross-border banking group, where do you see the biggest constraints today on scaling banking activity efficiently across Europe?
Well, at the end of the day, thinking everything through, I think that one of the biggest constraints is that we continue to be in a situation of lack of trust. which plays a major inhibiting role in scaling cross-border. I'm going to elaborate on that, but maybe let me just say that I agree a lot with both Emiliano's and Gonzalo's short analysis and observations. Back to my conclusion on trust. Yes, we're a bank which is already present in several countries in Central and Eastern Europe in particular. And we witness several circumstances which are far from ideal and which demonstrates the incompleteness of the single market in banking. The most prominent example of this is perhaps the inefficient allocation of both capital and liquidity within banking groups. They're being trapped in local subsidiaries. Waivers are available in theory, but in practice not really used. And to be very frank, I do understand, and actually very much so, that national authorities remain reluctant on relying to resources held in other member states, and that they wish to sort of ring fence capital and liquidity within the borders to keep full control of them. But this makes you as a bank perhaps think twice before you scale across borders. And I see that actually as a reason amongst many, of course, why we probably have comparatively seen more domestic M&As than cross-border M&As in the past. Again, is it a fundamental consideration or more fundamental consideration than the points made by Emiliano and Gonzalo, in particular the fragmentation? Perhaps not, but I wanted to give you nevertheless this practical perspective of a cross-border bank, which you wish to hear.
Thank you, Sebastian. So far, we've looked at this largely from the banking side. But one of the interesting features of the current debate is that it increasingly overlaps with the wider question about how Europe finances growth and investment more broadly. So Christoph, let me bring you in from the private capital side. One of the interesting features of this debate is that it is no longer just about banks in isolation. It increasingly overlaps with the broader question of how Europe finances growth companies and strategic investment. So from your perspective, where do you see the banking competitiveness debate fitting into the wider financing ecosystem?
Thank you, and thank you for inviting us. So just as a way of background, so Invest Europe represents the venture capital, growth, infrastructure, and other long-term equity managers that invest in startups, scale-ups, and more established companies, as well as their investors. So we also have a few banks in our membership. If you allow me, I'll be a bit provocative and assume that a big part of the EU lack of competitiveness is the lack of innovation financing, which is not entirely true, but it is at least partly true. And if you're looking at banks in the way I'd say nearly every EU policymaker does, and to a certain extent, sometimes the way the banks see themselves as well, as effectively primarily lending bodies, then the debate on banking competitiveness and EU competitiveness are more or less correlated. I mean, this is what Draghi has been saying on banks are not well tooled to invest in innovative companies. He looked at it from perspective of screening, etc. But kind of this is a general feeling across the board. And so from that end, whatever changes are proposed today, effectively, I mean, again, provocative, do not matter to EU competitiveness because the premise is that banks perform another, however meaningful role. And I know from, kind of from Gonzalo's remarks and Sebastian's remarks that, banks do more, banks lending activities play a big role. Securitization can help them to lend more. But ultimately, the companies that are truly lacking funding in the EU, the startups and the scale-up, they need equity. And this is the model we represent, of course. And what we see is that, to have equity, they need, they need obviously venture capital, etc. But venture capital needs funding. And that funding comes from institutional investors, sophisticated investors. And so you need banks also as part of the deal. And if you look at the banking competitiveness debate as a comparison with the US and see that in the US loans account for 40% of the assets compared to 60% in Europe, according to a recent EP report, well, then your question is how bank can affect a marginal proportion of their balance sheets to long-term equity and then financing innovation through these. And I mean, I want to be extremely clear. I'm not saying banks are as well tooled as pension fund and insurers to invest in long-term equity. I mean, they have their own liability reservation, they have their own liquidity constraint. What I'm saying is that today, with the punitive risk weights for any equity investments, we are preventing banks to perform any role in the innovation ecosystem, as opposed to big role, but at least some role. So we'd argue that if you want to solve the lack of financing for innovative companies, you either have to move people massively away from deposits, so to an extent shrink banks, which is one of the objectives of the SIU to an extent, or you will have to make banks more agile. And because we have not really seen that yet, I would say no, the two debates are decorrelated. Again, provocative view.
All right. Thank you very much, Christoph. So if I try to pull together a little bit what we've heard so far, the competitiveness debate seems to be less about whether Europe needs strong banks and more about what kind of banking system Europe now needs, one that remains resilient, but is also better able to channel savings into productive investment, to operate across borders and work alongside capital markets. So this brings us to the next section of our panel. If we establish the diagnosis, what actually needs to change? So we will now turn to the reform question. The broader debate seems to revolve around a few recurring issues that were mentioned: on fragmentation, on complexity in the prudential and supervisory framework, also uneven implementation across member states, and also the challenge of making the framework more supportive of growth without undermining stability. So, Gonzalo, I will start with you. Simplification has become a central theme in the banking debate, but it can mean very different things in practice. So, from the industry's perspective, where is the current framework most unnecessarily complex? Is it in reporting, prudential rules, supervisory processes, or resolution planning? And where would simplification make the biggest difference in terms of banks' ability to support lending, investment, and growth, rather than simply just reducing compliance burdens?
Yes, Andrea, I think complexity is all over the place. You've mentioned reporting, the prudential framework, and supervision. Those are the main pillars. And I would say in reporting, yes, we've gone too far, and we need to also rationalize the reporting. I think the EBA has a serious program that was presented last year to eliminate duplications with legacy reporting from the national supervisors. I think it's been already 15 or 16 years of the EBA that has built a European database that covers the banking sector for all purposes. We have been come a long way with the supervisor in the Eurozone, 12 years. So it's time to move towards a European model and leave behind much of the duplicative requirements at national level. We're hopeful that will really bear fruit. But the real matter there in terms of competitiveness is the prudential rules. There, the focus has to be put in the gold plating that has grown in Europe for historical reasons, but has grown too much in Europe. Also, the use of discretions given by the international standard setters that have not been used in other jurisdictions, but in Europe we have made a very, very intense use. And in terms of supervision, In terms of supervision, let me say that it has been a very successful experience to have a single supervisor. The proof was that in the international banking crisis of 2023, we were receiving here in the European Banking Federation many calls by people interested, journalists asking, will there be contagion? How many banks will fail in Europe in the following days to the Silicon Valley and Credit Suisse cases? In only 4 days, the single supervisor came out saying that everything was under control and there were no more calls and the market went up and the market valuation of European banks. So we need to appreciate what we have built together, but at the same time, a supervision needs to be streamlined. There is a program to clean it up. There are some interesting developments in terms of fast track processes where we have participated as the EBF, but in other areas we are asking to speed up the process and cut down supervision. As I say, I have long experience in banking. I've been supervised by many supervisors, and my impression is that today all banks are supervised as if it were the last day of the bank in a state of emergency. We need to tone down a little bit that supervision, at least for the many banks that are really resilient. So moving to concrete measures, one of the areas where we really need to do something effective in this reform is the scope of macroprudential. Yes, in macroprudential, during the build-up of the regulatory reform, there are many tools at the disposal of national authorities that, of course, they need some tools, but the size of the tools is huge. Let's just put a very easy equation. When it comes to macroprudential, the national authorities have capital of more than 10% of requirements, with the countercyclical buffer 2.5, the systemic sectoral buffer 5%, and the OC domestic systemic buffer that can go up to 3%. That's more than 10%. That is a game changer. There is no business model that can resist that uncertainty. And these tools are being used in some countries more, in others less. And suddenly they come up in the middle of the year with a new requirement. So that part really needs to be streamlined and really very well explained. Our proposal in the EBF is to remove this systemic sectoral buffer, and we are not the only ones requesting this, because there are other tools. And also to cap this systemic domestic buffer, because it's gone too far, to 2.5%, the same size as JP Morgan, that it's not consistent. We need to cap it at 1%, for instance, so leaving some room for the national authority to play with the financial stability at local level, some room, but constrained and limited. That is our proposal. In terms of overall requirements, we also think that we've got enough and we need to freeze any additional capital add-on. We have to stop a situation where we see that year after year, for one reason or the other, the total capital requirement grows. Sometimes because the European supervisor, other times because of the national supervisors, or because Basel 3.1. So what we need is to put a stop to that continued increase of requirements. And finally, the third measure that we are hopeful will happen also with the agreement of policymakers in the next months is to reduce gold plating seriously. There are many gold plating measures that are very heavy, and this needs to be toned down, because that's exactly what others are doing. Let me put examples. I talk about Chinese and Japanese banks. In Japan, they apply the Basel framework to the letter, fantastic, but no more than that. There is no OC buffer. There is no countercyclical buffer, 0. There is no Pillar 2. There is no NPL backstop. There is nothing like that. So at the end, the requirements for a Japanese bank are like 40% less than for a European bank on average. In the US, they also have some sort of gold plating in a different configuration, but they are reducing it very, very seriously. And I think in Europe, we should follow the same route. Those are our recommendations. And also to, I come back to what I said before, look at the specific portfolios as well. Yeah, we live in a world of risk aversion, and we need to be more able to accept that banks are precisely the institutions that are more able to manage risk and give them more capacity. Christoph has mentioned before also investments in equity that I didn't mention before. They're simply prohibitive for the banks now. We need to look at that because banks are part of the financial system and they can contribute. They cannot solve all the needs for equity, but they can help. And there is also an important matter. When a bank invests a bit in equity in a company, others follow because trust is built on that company. So these are important matters that we need to solve in this reform to let banks take on a bit more of risk. This is important. I stop there. Andrea, back to you.
Thank you, Gonzalo. So that goes to the heart of the current debate, because the real question is not just where complexity exists, but also where obstacles matter most from a policy perspective. So Emiliano, if you step back from the technical detail, where do you think Europe should focus first? Once a banking framework that is more supportive of competitiveness and investment? And what are the highest priority obstacles to tackle?
No, thank you very much. And actually, I'm very happy to speak after Gonzalo at this point. First, let me set a little bit the scene. So before discussing what needs to be changed, I think it's important to recognize what has worked. And some of you already have said that. So the post-crisis reform are delivering a much stronger European banking sector. This is undeniable, and Gonzalo already also referred to that. And the European banks today are well capitalized, liquid, and profitable. And they demonstrated, as we said, resilience through pandemic, energy crisis, and 2023 banking turmoil. Now the question is about ensuring that this resilience translates into greater capacity to finance our future. So the first priority, as I mentioned before, is reducing fragmentation across national border. Europe has a single rule book and common supervision, but banks still operates largely within national markets. And this fragmentation limits economies of scale, prevents efficient allocation of capital and liquidity. So let's think about how much capital level, and also reduce opportunity for cross-border diversification, which is also a financial stability component. So you can achieve actually two objectives on blocking that. So at the time when Europe faced unprecedented investment needs, I recall the 1.2 trillion annually as highlighted by the Draghi report. So we need that banks can operate and allocate resources across the union more efficiently. And a more integrated banking sector will strengthen the competitiveness and allow us basically to finance strategic priority like clean technology, digitalization, defense, and innovation. Now, this is about the cross-border dimension and the fragmentation dimension. However, as also Gonzalo referred to, a second priority is to ensure that the regulatory framework remains international credible, while of course taking appropriate account of European, in a way, specificity. So international standards remain the foundation of financial stability, but the implementation should avoid unnecessary complexity, and many of the complexity have also been mentioned by Gonzalo, or be at a competitive disadvantage, where, we can have some flexibility. So, and here I will simply mention the reporting requirements, how much efficiency we can create just in that area, but not only, yeah? So in a way, the good news is also that many of the things that Gonzalo referred are in the mind of basically and the objective of the communication itself and the following step forward. So proportionality is particularly important so that regulatory requirements match the size, complexity, and the risk profile of the institution. And finally, so I said market integration, second one is proportionality, and the third point is the simplification angle. So complexity creates operational costs, divert resources towards compliance, and can actually, as I said, reduce capacity to support the real economy. I simply would refer very generally, and I'm sorry for that because we're going through the presentation of the report itself at this moment in time. So let's just think about the overlapping requirements between micro, macro, and resolution requirements. All requirements which were introduced in parallel at different times, overlapping to each other. So how much efficiency gains we can have just on looking at it and solving these peculiarities, which are also peculiarity of the EU framework. But simplification, of course, should not mean deregulation. We should make the framework more coherent, predictable, and efficient. So ultimately, it doesn't have to be a choice between stability and competitiveness, but the two can go basically hand in hand. So we can indeed unlock the full potential for the European single market in banking and the banking union by reducing fragmentation, having more proportionality, and simplifying the framework. So now stop here. So thank you, Andrea.
Very clear, Emiliano. Thank you. Turning to Christoph now, one criticism often made of Europe's financial system is that it remains too segmented between bank finance and market finance. So if the EU wants to mobilize more long-term capital, how should the banking competitiveness agenda interact with efforts to deepen capital markets and scale up institutional investment?
Thanks. And indeed, the key question is how we can scale up the ability of banks to invest, again, a small part of their assets in long-term funds, and not directly support startups and scale up, because I mean, let's face it, investing directly in them would be too risky. I think the question is to scale up from where, and let me give you some numbers. Today, banks do not represent more than 5% of the overall private equity fundraising, so around 4 times less than pension funds and less than insurers, less than sovereign wealth funds, and actually less than sophisticated investors. Well, they have 50 trillions of assets, or more or less. And if you compare it to the European assets that are under management of private equity, it's around 1.2 trillion, so 15 times less. And much of that was raised from outside the EU. So if you're looking at the average investment of banks in private equity, it's 0.01%. And if you look at it in terms of venture capital more specifically, it's 1/10 of that. So at some point, you just need a microscope to see it. But other than that, it may be the right numbers. The question is, whether CR is ultimately coherent. And to the points that Emiliano made, indeed simplification is important, and indeed there is an element of it depends on the bank, but there also is an element that sometimes the rules are not entirely coherent. Today, banks have the same risk weight when they invest in a startup that if they invest in a diversified private equity fund. That's Article 133 of CRR, which means that on average it's more interesting for banks to make a direct investment. And so we think that there should be an opportunity with this review. Is typically the right moment to consider how the risk weights do not necessarily have to be lowered or increased or etc., but just have to reflect the reality of the reason our industry exists is, of investing in diversified fund and the benefits in terms of risk diversification that it brings you. And CR can do that, especially since it already exists in many other frameworks. Solvency II has several kind of components like that CR doesn't, and the two frameworks are not exactly the same, but there are considerations that can be had. Again, we are not suggesting for banks to become suddenly massive equity investors. That's not the point. But if we can get out of that review with the impression that investing in a diversified fund is not the same as investing in investing directly in a startup, I think we will have won something, and we will have won, on top of simplification and other aspects, we will have won coherence as well.
Thank you very much. Sebastian, I will now turn to you. So banks are now being asked to support a growing list of strategic objectives from industrial upgrading to digitalization to defense and energy resilience. Do you think that the current framework is flexible enough to allow banks to play that role effectively, or does it still reflect a more, let's say, defensive post-crisis mindset?
Well, to begin with, in my personal observation, it's actually not unusual or completely new that banks are being asked to help implement strategic objectives. The arguably most popular example from recent years is probably the sustainability Green Deal agenda via different sustainable finance initiatives and vehicles. And in recent months, as you mentioned correctly, yes, evidently, defense, energy, for example, have been added to the list. And I want to be very clear about that. What counts for a bank in the first place is obviously a sound and sensible risk management. Political prioritizations or political prioritizations alone are definitely not the single reason to provide loans. If a company's business model or business idea is considered doubtful from a risk management perspective, no political agenda would overturn a negative decision on a loan application. And I think that supervisors will very much agree with that. While I don't see a major credit crunch right now, I could nevertheless give an example about how things could be facilitated to allow banks to play the role you described more effectively and ultimately to the benefit of financing Europe's strategic priorities. It's about large exposure limits, and I apologize for being technical for roughly 30 seconds. In my first intervention, I referred to capital and liquidity being trapped. And yeah, what does that mean? That means that a banking group cannot deploy its cheapest funding across Europe efficiently, and excess liquidity in one country cannot easily offset funding needs elsewhere. So eventually, the funding costs for an entity become higher than they would be in an integrated market, as the different entities of a group need to seek funding individually. What does that lead to? When the funding costs are higher, the assets will also be higher priced. Banks may absorb a portion of this increased cost for a certain amount of time, but a logical consequence is, of course, a loan price increase. And this is not ideal at times when financing demands, which go hand in hand with new and important strategic priorities, are high.
Thank you. So far, we've been discussing Europe at a fairly aggregate level, but one of the risks in this debate is that it becomes shaped mainly by the realities of the larger Western European banking markets. So I would now like to bring the discussion much more explicitly to Central and Eastern Europe, because many of the region's financing structures and investment needs look quite different. So Sebastian, I will start with you. So Central and Eastern Europe remains more bank-based than much of Western Europe. And in many countries, the banking sector is still heavily shaped by cross-border groups. So does the current EU debate on competitiveness adequately reflect that reality? Or do you think there's a risk that the policy discussion is still too centered on the needs of larger Western markets?
Well, first of all, of course, deeper capital markets are more than useful. In particular, the CEE region still has a long way to go there. There is no doubt that this complementarity of bank financing and capital markets financing needs to be the reality to actually strive for. Besides capital markets, I would generally say that at times the CEE region has particular needs that should not be overlooked. And let me give you two examples. Their green energy transition, for example, could be a harder and longer process than elsewhere in Europe. And also, if we look at housing, there seems to be an even bigger issue than in other member states, as, for example, when we look at the statistics on overcrowded households, the rates are even higher in CEE. In many policy debates, generally speaking, again, I would agree with your impression. At times, I do have the feeling that CEE continues not always being given sufficient consideration. And that's a pity, in my view, especially in the economic and competitiveness context. CEE has been the EU's economic growth engine for many years, and actually to the benefit of the entire EU. What CEE must perhaps do better or more is coordinate and speak with a more unified voice. And one key debate in this respect, which has actually already started, and that's my last thought, is the discussion about the next EU multi-annual financial framework. The pot for cohesion financing could, in a bad scenario, become smaller. And while cohesion financing is crucial for CEE, it attracts investments, it generates growth, jobs, wealth. And I see this actually as an important opportunity for CEE to speak with one voice, to fight for sufficient funds on cohesion, and to counter what he mentioned, this perception that Western markets are more in the focus of competitiveness and economic growth.
That is a very important point, because it highlights also that the CEE question is not only about banking integration, but also about the wider financing ecosystem around it. And even where the banking sector remains central, many companies in the region still face difficulties once they move beyond the, let's say, early stage and need longer term growth capital. So I will use this opportunity to bring in Christoph. So one of the structural weaknesses across much of the region is not the absence of entrepreneurship or innovation, but the limited availability of long-term growth capital once companies move beyond the early stage. So how do you see the relationship between bank financing and private capital evolving in the region? And what would need to change for CEE companies to scale more effectively in your view?
Yeah, I think unfortunately the problem in the CEE region is the scale problem is something that is real across Europe. I think on top of it, with the CEE region, you also have a startup problem, and kind of you also have issues in kind of having enough capital at the early stage kind of part of the ecosystem. And when it comes to bank, I have a slightly funny story. Is that once I was using stats for, I think, 2024, which were showing kind of the size of the the banking as part of the overall fundraising ecosystem, and it told a pretty positive story for the CEE, because I think it was 70% of kind of bank capital, as if it was one of the places where bank capital was vibrant. And I was asked by your Polish colleagues of the Polish Private Equity Association to change the number, because effectively that was true for 2024, but not for 2025, where it was 0. And the reason, and I think that story tells a story of an ecosystem that is not very mature in terms of ability to fundraise. It doesn't mean that it's there is no investments, there is no entrepreneurship, etc. There is, and if you actually look at Estonia in terms of overall venture capital investment, it's well above the average. So there are, it depends on the ecosystem, but it can work. The real problem is fundraising, and there I think the problem goes beyond the rest of Europe, including from a banking perspective, but not exclusively, because the entire region is still very dependent on capital coming from outside of this EU, whether EU or non-EU, or frankly from public financing. To that extent, I think we can talk about regulation, etc., but it's also about a change of mentality. I think if you look at the pension funds in the region, they're very restricted in the way they are able to invest, and realize that financial education is not only for retail clients. Sometimes it's just convincing types of investors that they can set up the teams, that they can develop their private capital ecosystem. But there is a lot of work to do, even though we kind of going in the right direction. We actually, as an association, doing reports for the CEE region that show that it's burgeoning, but there is still much to do.
Thank you. So if one part of the challenge is the structure of the financing ecosystem itself, the next question is what this means for the EU broader integration agenda. So if the Savings and Investment Union is meant to work for the whole union, it has to work not only for deep capital markets, but also for economies where banks remain central and market-based finance is still developing. So Emiliano, if the Savings and Investment Union is meant to work for the whole union, including for countries where capital markets remain relatively shallow and banks still play a particularly central role, from the Commission's perspective, how should the banking competitiveness agenda support convergence in Central and Eastern Europe rather than simply deepening asymmetries within the single market?
No, thank you very much. I will start basically with two words that Sebastian said and mentioned: complementarity and trust. And I think these are two very important points. And then Christoph mentioned innovation, and you finance innovation also through what we call the SIU, and also a more integrated banking sector. But the starting point as SIU, like the more integrated banking sector, can only be successful if you work for all member states. And the approach is not to replace banks with markets, but to complement a stronger banking sector with deeper and more integrated capital market. Just as banking integration can help improve access to financial services across the Union, the SIU aims to ensure that companies and investors can benefit from a genuinely European market for capital. So the parallel is also clear in the way we approach integration. So in banking, the objectives have never been to concentrate activity in a handful of financial centers, but to remove barrier to cross-border businesses while preserving diversity in the business model. For this reason, integration goes with proportionality and simplification. And SIU, in a way, follows also the same logic. So remove obstacle to cross-border investment and market infrastructure, allowing smaller and less developed markets to benefit from larger pool of liquidity, economy of scales, and wider investment opportunities. So better integration means local firms gain access to a broader investment base, households have more investment opportunities, and economies have more sources of financing. So at the same time, banks remain key intermediaries and stand to benefit from more efficient and deeper capital markets that expand financial options for clients. So ultimately, the same principle apply to both banking and capital market agenda. So more integrated SIU and single market basically strengthen competitiveness, enhance resilience, and support also convergence across all member states. So ensuring that the benefits are shared across union. But to achieve that, I will remind the word that Sebastian said, which actually is the key to unblock many of the discussion we have since many years, and is trust. So I think we have to trust each other. So thank you, Andrea.
Thank you. And that brings us to the practical question of what this means for banks themselves. If Central and Eastern Europe is to continue converging, and if banks are expected to remain one of the main channels to which that convergence is financed, then the framework also has to give them the capacity to play that role effectively. So Gonzalo, so banks have been one of the key channels through which economic convergence has been financed in the region over the past 2 decades. But the next phase looks more difficult due to weaker demographics, lower productivity growth, more strategic investment needs, and tighter public finances. So what will banks need to do in order to continue playing that convergence role?
Yeah, thank you, Andrea. That's as you say. Well, banks have been there in the region on a continued basis. So these are strategic long-term investments, and there are also local banks, of course. You mentioned the last 2 decades. That's a span of time of 20-25 years since the joining the union that has been characterized by important growth and cohesion and opportunities that joining the European Union brings to new countries And that you mentioned, I found you a little bit pessimistic. I'm much more hopeful than that. And that reminds me. I'm Spanish. Spain entered the Union in 1986, and I remember in the late 80s, beginning of the 90s, there were a lot of opportunities because of joining the EU. Many companies settled there because there was talent, and then at a lower cost than in other countries, and that gave a lot of opportunities. But there was also, after 25 years, a turning point with the crisis of 2007 and the euro crisis. And I think many of those advantages that Spain enjoyed move away, and you have to reinvent yourselves as a country as well. But there are other opportunities. To me, there is one key in the Central and Eastern European region, which is to create local companies. Local companies have been growing, and that is the key to continue being relevant, and especially to avoid the brain drain, because the possibility of talent going to Frankfurt, Paris, or London should be an option, but not an obligation for people. And there is so much talent going away that should be a priority. As Emiliano has said, and the Commission is looking at developing the region in terms of removing cross-border obstacles, and that is very important. When it comes to banking, I remember I participated in the first Vienna initiative in 2011, and thanks to your invitation to this conference, I have taken out from the drawer that report that we presented at the Commission in 2011, and I participated together with supervisors. And some of the recommendations made there are still relevant. One of them that caught my attention was that maturities in the banking facilities were shorter than in other countries. And I think that that's an important element. As we mentioned before, we need long-term funding given by banks. We need to stimulate it with a regulation, but even more in this region than in the rest. And also an important recommendation was to develop local capital markets, which is also important for banks, because then banks can fund themselves with a local bond market, and that makes it easier for the banks to comply with the rules, with the stable funding ratio and the liquidity requirements, and so on. So I think it's very important that, as Emiliano said, to place the focus of the SIU also in developing the capital markets in the region, so that investment can be channeled towards the region that can offer at the end an equation of profitability and growth that is still superior to other regions in the European Union. But that needs to be stimulated, and the local market has to be created. So leave it there. There are other things that I think for the banks are important. Also, the combination of capital coming from other countries with the know-how and the minority interest in the countries is important, because it keeps a common interest between local investors and foreign banks that are bigger simply because they are bigger. But again, the development of local companies should be a priority for the future, and I'm optimistic about that, seeing all the talent that is available there that should stay in the region.
Thank you very much, Gonzalo, and thank you to all of you for the very insightful contributions. Perhaps we can quickly take a question before we close off the session. So one of the lessons from the global financial crisis was that the economic cost of a financial crisis are huge, and there is substantial research highlighting that strong banks only continue to lend in a crisis. Therefore, would the lowering of regulatory requirements not increase the risks of financial crisis with substantial risk to economic growth? I don't know if anyone would have any response to this?
You can say from a bank's perspective, maybe, that probably everybody in the call anyway agrees we do not want to go back in any way to the pre-great financial crisis levels. That's clear. And I think the discussion rightly is not about a race to the bottom that we have now in Europe with our prudential requirements, but it's rather to see where there's room for optimization, to remove the fragmentation and maybe to remove some gold plating. If we only remove the gold plating, we are in any aspect way above of where we were before the great financial crisis. Just speaking about capital and liquidity now. But in addition to that, we have stress testing. We have a very detailed recovery and resolution planning. We have many more reporting requirements for a centralized supervision in Europe. And rightly so, we are not questioning anything of that. So in this case, Gonzalo, I'm with you. I'm on the more optimistic side that we will not repeat what we did in the past, and the world, and in this case, Europe, has learned the lesson.
Yeah, maybe if I just compliment, I would like to add, this is about really unlock the potential. There's framework in terms of regulatory to do there to address some of these barriers. This certainly will help economic growth and financing of the economy.
All right. Thank you very much to all of our panelists for an excellent and very timely discussion. I think today's conversation made three broader points particularly clear. One, that the debate on banking competitiveness is no longer a narrow discussion about bank profitability or regulatory burden in isolation, but it has become part of a much wider question about Europe's economic model, whether EU has a financial system capable of mobilizing capital at the scale needed to support growth, innovation, industrial transformation, and strategic investment. Second, that competitiveness in banking is not simply about doing less regulation, but also on how to make Europe's financial framework more coherent, less fragmented, and better able to support cross-border activity. And third, that Central and Eastern Europe needs to be part of this conversation in a more explicit way. So the real test of the European banking competitiveness agenda will not be only whether it makes the sector more efficient, but whether it helps to build a financial system that is more integrated and more investment-oriented and more capable of supporting convergence across the whole European Union. So on behalf of CEE Perspective, thank you again to all of you and to everyone who joined us today.
And I can confirm that the report is public now.
Yes.
So go on the website. Thank you for the invitation. It was great to be with you.
Thank you,
We have
Andrea.
something to read over the weekend.
Yes, thank you to all our panelists for such an insightful discussion. If you just bear with me to share a message to our audience. Dear audience, you have now heard the perspectives of our experts, and very soon, well, now you can start to compare today's discussion with the findings and recommendations published by the European Commission. We would be very interested to hear your views. In particular, please let us know which aspects of banking competitiveness deserve greater attention from a Central and Eastern European perspective, and which issues relevant to the region were not fully covered during today's session. Your feedback helps us shape our future work and ensures that the priorities of the region remain part of the broader European debate. As Sebastian highlighted during the discussion, Central and Eastern Europe must increasingly join forces and speak with a stronger, more coordinated voice. This is precisely what CEE Perspective seeks to support. Through our publication, events, and academy sessions, we address the most relevant developments in European financial policy and regulation. Each month, we select one major topic and break it down to its key elements. This month, as you have seen, our focus has been on EU competitiveness. And every Monday, we also publish our weekly newsletter, highlighting the most important developments ahead and explaining their relevance for the Central and Eastern Europe. You can follow us on LinkedIn and on Instagram. Visit our website at ceperspective.eu or contact us directly. Recordings of our previous webinars together with our publications and other materials are available on our website and our YouTube channel. Thank you once again to our speakers, our moderator, and all of you for joining us today. We hope you will continue to follow our work, and we look forward to welcome you to our next events. Have a good afternoon, everyone. Thank you.
Thank you, everyone.
Good night.
Bye.
Bye.